very good evening to you traders. It's Mark here from the Day Trading Room. The time is, it's 20 to 8 in the evening, London time on a Sunday evening. And it's been a while since I've done a video for the blog. There's a couple of written blog posts. Go and check those out, TheDayTradingRoom.com. If you haven't already, some different interesting topics there. But it's the first time for a while I've done a video. And really it's because, the trading has been very light. I'm fortunate enough not to have to be involved with the market when I don't perceive it to be that offering that much opportunity. And yeah, there's plenty of opportunity in the market, but not as much as perhaps there could be if it was very active. So I'll take a back seat and just keep an eye out for specific setups that I want to take, and just be very, very choosy. And if that means a couple of days without a trade, that means a couple of days without a trade, guys. I'm not going to be trading stuff just for the sake of it. Unfortunately, this one setup, which we'll run through in a minute, is one which you don't necessarily have to be as purely and intently focused on the market as pretty much all my other setups. This is one in the library of repriced setups, which most of the time you'll have to be fully in tune with what's going on with the 1 minute cycle. Where we are on the 60, how the market's been behaving in the first 15 minutes, what the overnight levels are, what the time of day we tend to get reversals. Are we being stretched? What sort of 3-4 minute moves are we getting? All that sort of stuff. You're writing down that in your journal if you're trading every day. But this is probably a rare setup type that you don't need a lot of that information. Now, obviously, you still need your key levels, your overnight highs, lows, prior days, high, lows, closes, opens, etc. But the premise of the trade isn't really based on the norm, if you like, the normal way it's trading, which is what you get a feel for if you're trading every single day, all the hours throughout the day. You get a feel for the normal, and then when the abnormal happens, you either fade that or join it. So this is a slightly different trade, and something that it allows me to take this trade if I'm not fully immersed. This is probably the only trade I will, in fact, it is the only trade I will take if I'm not fully immersed in the market. But this is really, I just want to talk about very quickly about the plan going through forward to 2012. Last year, same sort of thing I had. I said I would look at other markets, and I did. Crude oil, started to introduce crude oil last year, which was great. Really glad I did that, because the Dow slowed right down, crude oil was active, and it was great to get on some great moves on crude oil. Different way of trading, takes you a while. You got to, if you're going to flip from market to market, you need to make sure that you're not still in the mode of the prior market. If you try and trade crude oil with Dow methods, then you're probably going to get stopped out quite a lot because of the nature of the way it moves. So pretty similar to last year, going through to 2012 for me. I guess sum it up in a nutshell: trading less, trying to trade less, but trying to get my best year ever. Now I think that's entirely possible again. Literally increasing size for the best trades, focusing really intently. I'm going to work a lot smarter this year. Really put my focus when the market is active and when there are a lot of opportunities. Obviously, like August 2011, loads of opportunities there. That's the day really when you need to be putting in the 14, 15, 16 hour days just on the screens, and just because that's when you make your money, and that's when you make a lot of money, and you can make your year's money in a month then. So that's pretty much my theory going into this year. Not going to be so caught up in every single move on the Dow. I'm going to be a bit more open-minded to other markets, getting comfortable with the Dow, if you can call comfortable. You'll never be comfortable in trading, obviously, but familiar perhaps is a better word. So like I did in 2011, I'm going to introduce some other markets. I'm going to start scanning, especially with the Facebook IPO coming up and all these recent social networking IPOs, LinkedIn as the stock I was looking for, LinkedIn and Groupon and all that. I think there'll be some interesting opportunities in stocks like those. So I've got one eye on some key stocks and stocks that are driven by news, because that's when you get opportunities. Opportunities come when there's volume, especially for us as we're day traders, and especially short-term traders, because volume means larger moves in a shorter period of time. Now, I don't mean crazy nuts moves like we did at the beginning of August. We got absolutely ridiculously huge moves. I mean good, strong moves, because the further the move, the more likely is, if you get it right and you're risking a small amount, that the trade really does pay for itself. Plus, the commissions and your costs, whatever, become less meaningful the larger the move. So, really opening myself up to that sort of those sort of opportunities going into the rest of the year. But let's talk about this trade here. This is one of the ones, as I said, that will occur now and then. Take them because it's just a nice setup. It's one of my bread and butter plays, and it's just generally based on the reprice. Something comes out, in this case some data came out 1:30 London time, spiked the market up for a while, actually for a long, I think probably the first time this year. We got a nice spike up. We actually got a nice 80-point spike up, which held. That's the important thing, as I've talked about it several times before. It's the response to price movement that matters. Bang, bang, and we're holding. We're holding nicely. I'm looking for the long. I'm always looking for the long, especially when you get into the 3rd minute and you're still holding. You're watching that first candle, spikes up, and you're sitting there. You watch that time, you watch. You get the first candle and we close up here. Okay, great. Now we're seeing strength holding. That's the main thing. Second candle, again closes up here. Forget about these wicks and stuff. Just the fact that it's closing in the upper quarter, upper third, upper half. Just have a sense of the bullish nature of it. In this case, we were right at the top of that candle. So coming into the 3rd minute, I'm now looking for a long entry. Now, we didn't get every pullback as such, we got a flag. Now, what made me buy it there rather than wait for a pullback and miss this? Now, I just want to bring this in and show you some a little trick. Trick, if it's the wrong word, I hate using that sort of thing, tricks. But let's just bring in this and show you what I tend to be looking at on something like this. I've squashed this one into one chart. Normally I have these spread across the screens. We've got Y in there, got the S&P, got the DAX down there, and at the bottom we've got gold. Now gold is obviously inversely related to generally the movement of, it's a bit of a broad statement that, but in terms of when there is news that is bullish to the economy, or bullish or perceived as bullish to the market or the equities, that generally gold's knee-jerk reaction is to sell, because that's just a risk trade being put on and gold coming off the table. So obviously correlation between YM, ES and DAX, and inversely correlated on the gold. So I'm watching the YM, I'm watching the tape on the YM, and by about the 3rd minute I'm looking over and I see the DAX has made a new high. Then if we can just see that there, DAX has made a new high. Let me just zoom in here. So I'm already now thinking, okay, if that DAX holds that high, then there's no reason to think that the Dow and the ES aren't going to follow suit. And especially as well, gold down here. If you see gold down here, it's not even, we're still pushing lower. We're still making new lows effectively. Okay, it's not such a drastic move as the others, but it's just something, and I definitely wouldn't make a trading decision just based on that. But it's all pieces that you can put together to generate information. I don't like overclouding stuff, and I don't like doing this under all the time. But it's just something that now and then you can look across and say, when you see a move that is based on economy, so it's data from the economy, or something that reprices all markets, then you can use this strategy. It's when you're starting to use this strategy, when you're just seeing the Dow break through a resistance level, that you're going to come unstuck. So it's worth, perhaps worth looking at. So 3rd or 4th minute, now the 4th minute, the DAX is holding solidly, and we're still pushing on. Gold has pulled back slightly, but I'm still pretty impressed with that. And just because I see the DAX now in the 4th and 5th minute really starting to roll, and by the 5th minute the DAX is just pushing on. DAX is pushing on, and the Dow is really starting to struggle. But I don't mean struggle as in it's looking weak. I mean struggle as in it's not breaking, but I just think it's a laggard. So at that point there, I'm all over that Dow. I'm looking for the new high. I'm looking for a push to new highs. Obviously taking the trade out as we push up into the new highs, taking the risk off the table as always, and then looking for a further move. In actual fact, we didn't really get much of a more of a move on that. I ended up getting some more out as we pushed up into high and holding some. I ended up holding it actually for quite a while, thinking that we'd do another leg up, but just before the open I ended up closing it because it just didn't really push as much as I want. But nevertheless, nice trade, nice high probability trade, and just using that European market just for the, not the trigger, but just to help guide you to say, yeah, you're on the right end of this. DAX is pushing on here, and the Dow is just a little bit slow. So, yeah, there was something interesting, something a little bit different, not something that I've talked about before, but something that I do tend to watch, and that's really why I use my rest of my screens for, is for looking for those sort of opportunities. And when something happens, I'm straight looking at the euro, looking at the yen. I'm not making decisions based on them, as I said, but just looking to see how their moves are correlated with the Dow moves. So I just wanted to show this very quickly as well. Stuff like this, this Netflix here, is the sort of thing that I'm going to be looking at going into the new year. The opportunities when you've got such a gap, or you've got such a strong open, or something like that. I know TradeStation doing an update soon, which will allow be easy to scan for this sort of thing. So, but this is like the classic trade in the Dow. If you see this, if this was happened in the Dow, it would have been just brilliant. You know, these are the sort of days that you really hope for as a trader. Huge gap up, and you get. And I've said it before, on the gaps up, I'm either looking for this push up, pull back, drive. Drive lower, pulls back and fills the gap. That's the rare one if it's on a full gap up, or the drift, and then the buy, and then I'm in for the first pullback. And this is pretty much what we've got on this Netflix here. Get rid of this. Now, the further you go without a pullback, the more likely it is that you're going to get a push higher. So that's especially true on the Dow. Stocks, time will tell. Let's see. Let me get a bit more information on those, and we'll get back to you. But yeah, nice push up there. There's your first pullback. If you had the ticks, obviously that was a Dow. I guess that would probably be coming back to plus 200 or 0, and then we'd be looking to buy that, and then the push up there. So that's the sort of thing I'm looking for going into next year. That sort of trade. And another thing I just wanted to show is on here. This LinkedIn on the 60-minute chart. Just interesting to see. I think that you've got opportunities like this around. So it pays probably to look for these opportunities going into the new year. This is nice on the 60-minute. I just found it interesting, actually. At least we just saw it now and thought I'd mention it. You know, holding this 72 to 71.70 level, hold. You get the fake out, but then you watch to see how the rest of the day holds, and then if it holds the rest of the day, you know, you're always trying to create the good risk reward trades. It doesn't really matter about the trade being right or wrong. You're just looking for the good risk reward. And when at this point here, when the market closes here, having visited here under that support and push back up, you've got a good risk reward trade. You know you've got the trend up behind you. I didn't take this, by the way. I'm just pointing it out, something I spotted. I don't want to mislead anybody in thinking I took this. I'm just literally pointing out some of the things that I was spotting. So, you know, good support there. We broke under and we held, and at the end of the day we closed above it. So there you go. There's your entry. The point is, we're looking for good risk reward. Your entry's there the next day. Okay, we gapped up slightly, and when we didn't fill that gap, you know, we're off. So your entry's on the next day there, or whatever you fancy, but there's your risk. Your risk is under there, and that's a good place for a stop. You know, you can see the logic of that. It's not just, you're not putting a stop just under the support. Like, this is pretty much all these people getting stopped out here are well frustrated. And I would guess if this is a 1 minute chart, guys, you know, you'd see this. People would be buying this because this is the textbook flag break, off we go. And then they'd be putting their stop under there, and bang, they're getting stopped out there. So I love trades like that. I love trades that just, you know, catching the textbook trader out. I don't like seeing people lose money, of course, but you know, this is the market. This is the way the markets work. And so, just seeing that dip under, nice low risk reward trade. It makes sense to put your stop under there, because the second visit is unlikely to be that little fake out that you've got there. So nice low risk trade, and then a low risk reward trade, and then of course your first scales at the high. And you've got a lovely trade. You've got a lovely trade there. So yeah, we'll talk some more about those coming in the coming weeks, and also got some other things in the pipeline, which we'll talk more about those later in the week. But yeah, trading related stuff, and I think everyone's going to get some great benefit from that. So looking forward to getting on with that. So I hope you all had a great January. I hope you all had a good week last week. And keeping that risk managed, that's the main thing. Not getting chopped up, recognising when your edge is there, when there are opportunities to trade, and when they're not, you know, just back off a bit. Just back off a bit. That really does a lot of people a lot of damage. You know, I hear from people who have done so well. They've done so well when the times are good, and then the market starts to slow down a little bit, and they're getting chopped up. They're getting frustrated. They're increasing size, and before you know it, they're undoing a lot of the hard work that they've done when they've been trading well and they've been trading disciplined, just because the market really wasn't offering them the opportunity that suits them. And it's all about the market suiting you. You know, if you're a person that loves to trade slow markets and you like putting in bids and offers and you've got a good commission rate and you're just putting them extremes, then fine. You know, that's absolutely fine. You know, it works for you, great. But if you're in a market that's not quite in tune with you, then pick your moments to strike. You wait your moments to strike, hit them, take your money, run, and then just sit and wait again for the next opportunity. That's the way to play it. Okay, guys. As I say, keep the risk managed, and look out for another video perhaps later in the week. Take care.